So the Islamic equivalent would be sukuk, right? And why do companies issue bond? Primarily is to raise capital, okay, to raise capital, and as we shall see also later, this is a form of raising capital that is cheaper than issuing stocks, okay? And even going into venture capitalists, for example. Okay? So many big corporations would opt for issuing bonds first as the first option. And later on also we shall see that the bond indenture or agreement, okay, are much more specific, okay, and compared to, let's say, if you want to issue stocks, we are subject to price fluctuations of volatility of the stock prices, okay, as opposed to bonds whereby many of the terms are fixed, right? So that's why many large corporations prefer bonds rather than stock issuance. Now, as I mentioned earlier, okay, in order to perform valuation, you need to know the cash flow streams. Okay? So what are the cash flows involved or the relevant cash flows for this particular asset? So when we talk about bond, so let's say we take a corporation, say Petronas, what is the listed Petronas Dagangan, for example. So when the company want to raise capital by issuing bond, okay, so they would go through a process with the investment bank, i.e. the underwriter, okay, the party which manages the issuance of bonds, and they will decide on how much, okay, bond to issue. So let's say they come up with a figure 100 million, and what happened here when a company issue bond is basically the company is borrowing money from the bondholder or the people, the institutions who purchase the bonds later. Okay? So those who buy the bonds, when they buy the bond, okay, they fork out the money, they pay some money to buy the bonds, they basically lend their money to the corporation that issue the bond. So the bond issuer, in this sense, the company, becomes the borrower. So when you issue bond, essentially means you borrow money. So in this case, from the public, when you offer to the public, and we have institutions and individuals purchasing the bonds, so those institutions, those parties become the lender. You as the issuer, you are the borrower. Okay? So you borrow the money. So by borrowing the money from the bondholders, there are terms and conditions. Okay? So in this case, there are indenture or agreement that bind you, okay, that bind you with the bondholder, i.e. the term bond. Okay? Meaning by issuing at a certain stipulated features, characteristics, okay, you have to fulfill certain obligations. Okay? Among others, you have to pay, okay, to, what we call a coupon payment here. Coupon payment, which is basically an interest. Okay? So you have to pay the lender some interest, normally an annuity. So every 6 months or every quarter or every year at a certain fixed amount. So that is what the bondholder will get from you, the issuer, okay, whenever they purchase the bond. And first and foremost, a bond needs to have a face value or a par value. Okay? In practice, normally the par value would be 10,000, basically in the developed markets. But for the sake of textbooks, normally all textbooks will use $1,000 as the par value for ease of calculation. Okay? But practically, it will be a minimum of 10,000 in the denomination of 10,000. Okay? And you agree on certain coupon rate, okay, which entitle you as a bondholder for a coupon payment. Now, This is an important feature, which is maturity date. So a bond has a maturity. It cannot be forever. Okay? So the length, okay, would be fixed, okay, and agreed upon. So let's say a 10-year or 8 years, okay, or 20-year bond. So it has a maturity date. And finally, the yield to maturity is the required rate of return. Okay, this is the prevailing interest rate for that particular bond as a result of this face value, this coupon rate, and this maturity date or length of the bond. So all these three would determine what would be the yield to maturity or the required rate of return. So in this case, you can already see that there are two rates involved. One is the coupon rate. This will determine how much the bondholder, okay, or the people who buy the bond will get every period, every 6 months or every year. And this yield to maturity would be the interest rate, the prevailing interest rate to calculate the value of the bond later. Okay? So these are all the specs, okay? The main features or specifications of a bond. Okay? So I mentioned here, by issuing bonds, the firm takes the role of the debtor who owes money to the many bondholders who act as the creditors to the firm. So in return, the bond issuer, okay, the corporation agree to pay the bondholders coupon payment. Okay. Normally, it's either annually or semi-annually. Okay. But in reality, it can be quarterly, it can be every 4 months. Okay. There are certain complications, but for textbook purposes, they use either annually or semi-annually only. Okay. So now, knowing that, okay, the cash flows from this bond would be the coupon payment. Okay. Now, some of you may wonder, why do they use the term coupon? Why can't they just use interest? Essentially, it is interest. Okay, but there's a history why it is called coupon payment, because the earlier bonds, okay, many hundred years ago, it was already bond being issued. They actually um, printed and come up with this coupon, okay? Printed coupon, paper coupon. Okay, so when you buy the bond, you are given a piece of paper which are perforated, so that when the time comes every 6 months, okay, when you want to claim your interest, you will tear up the coupon, okay, the perforated sheet, and go to the company and claim your interest. So that's why it is called coupon, because practically and physically or literally it was a coupon. But nowadays, of course, we don't use that. We just bank into the bondholders account. So now, in order to perform valuation, okay, it is not that difficult, because you know that in front of you, whenever you issue a bond, there are two types of cash flows. Okay. First one would be the interest payment, the coupon payments. Okay. A series of coupon payments or interest payments, which you know are annuity, because the amount is the same, it must be fixed, okay, and it is recurring for a certain period of time. So you know that the first cash flow, which is the interest payments, are annuity. So you would use the annuity, present value annuity formula, okay, that you have learned earlier. And the next one would be, okay, this is a special feature of a bond. Upon maturity, when the bond matures, right, the bondholder will get the face value, okay, the face value or the principal, okay, which I mentioned earlier is 1,000. So when the bond matures, okay, upon maturity, in addition to receiving the last or the final interest payment or coupon payment, the bondholder will also receive the face value or the principal, okay, which is we will use 1,000 in this case, right? But this one is a single amount, not an annuity. Okay? So that's why the present value of a bond, value of the bond, if you want to value it today on the issuance date, right? Whenever you want to issue, would be the present value of the interest payment annuity, okay, which is this formula, plus the present value of the maturity value, which is the 1000 face value of principal that I mentioned earlier, right? So you combine the two, right? Notice that, okay, I use I here, and okay, this is to be consistent with the basic formula that I have exposed you to last time. Okay, but know for the fact that, okay, when I use I, this is general interest in general. But in the case of bond, right? Okay, in the case of bond, it can also be called required rate of return. So the question may be phrased in such a way that they don't use the word interest at all. They use required rate of return. And this is, in its essence, is the yield to maturity. The yield to maturity for this particular bond. Now, in order to understand what yield to maturity is, right? Actually, the term is self-explanatory. Okay? Yield means what you will get, the return, okay, that you will generate. Okay? To maturity means, okay, from now, the moment you buy the bond until it matures, until the bond matures. So what would be the return to you as the bondholder, right, from buying the bond, okay, and getting the interest payments and getting the maturity value at the end, if you buy now and hold on to the bond until it matures, okay, until maturity date. So that is what it means by YTM, the yield to maturity. This concept is very important later as we explore more into this bond valuation topic. Now, the PMT, I use PMT to be consistent, as I said, to standardize on the original formula. Okay, but for the case of bond, this PMT is actually the coupon payment. Okay, coupon payment. Okay, how do you calculate a coupon payment? Okay, you must know what is a coupon rate and what is the face value. Okay, as I mentioned earlier, we will use 1000 consistently standardized, okay, for throughout the course. Okay, so if the coupon rate is 6%, for example, okay, multiply by 1000, the face value, so the coupon payment would be $60. Okay? That is if it is paid annually once a year. But if it is semi-annual, 2 times a year, okay, so you have to divide by 2. 6% divided by 2 would be 3% times 1000. So you will get $30 every 6 months. Okay? So if the maturity is 10 years, so you will get $30 every 6 months for 10 years. But if it is an annual coupon, you will get $60 per year for 10 years. Right? So we only have two variations here, annual coupon or semi-annual coupon. Okay? And based on what we understood from the time value of money, since this is present value, okay, notice that this is a present value of an annuity, this is present value of a single amount. So since this is a present value, so therefore the value of the bond is inversely related, okay, inversely related to interest rate. So we know that this value of bond VB here is inversely related with the I, interest rate, meaning the higher the interest rate, the lower would be the bond value, and vice versa. Okay, the lower the interest rate, the higher would the value of the bond be. Okay. So let's look at a simple example here. Okay. What is the value of a bond with a par value of 1000? Standard. Okay. Maturity period of 10 years, 10% coupon rate, paid annually, and interest rate is 10%. So the first and foremost, we calculate the coupon payment PMT, which is a coupon rate here 10% times the par value 1,000. You will get $100. The coupon is paid annually. So utilizing the time value of money, you know that since M is 1 annual, so N equals to 10 and I equals to 10%. So what you do is you just plug in into the formula. Your PMT is 100, your I is 10%, your N is 10, so to the power of negative 10 here, divided by I is 10%. Okay, so you solve this first. This is the first term, the first chunk of the formula. The second chunk would be the maturity value, which is 1,000, times 1.1, which is 10% interest here to the power of negative 10. Okay, when you do this, if you solve this, you will get the value of the bond to be 1,000. Okay. So notice that the value of the bond is equal to the par value, the 1,000 par value. So the value of 1,000 is equals to the par value of 1,000. Now this is so because, okay, this is an important relationship. Okay, the coupon rate is equal to the interest rate here. Whenever the coupon rate is equal to the interest rate or the required rate of return or time yield to maturity. Okay, remember interest rate or required rate of return or yield to maturity, they are interchangeable. They are the same. The value of the bond would be equal to the par value, i.e. $1,000. Meaning, if you have this scenario, you don't actually have to calculate like this. You know for a fact that whenever the coupon rate equals the interest rate or yield to maturity, the value of the bond automatically, you know, would be equal to the par value, which is $1,000. Okay? This is just to illustrate. I'm showing you the calculation in the first uh, earlier part here, okay, to show you that it is equal. Okay, now let's look at example 2. Now we change a little bit, whereby the coupon rate, we make it 8%. We change the coupon rate to be 8%. The rest remain the same. Par values remain 1,000. Maturity period 10 years. Interest rate is 10%. So in this case, you calculate the coupon payment first, which is 8% times 1,000, which is 80. Similarly, the rest is the same. Coupon is paid annually. Interest rate is 10%. So the only difference now would be your PMT. Okay, now it's 80. When you do this, you will get the value of the bond to be 877.11. Now we have a case where the value of the bond is less than the par value. Okay, 877.11 is less than the par value. Okay, let's go to the third one. Okay, now, okay, this you make changes here. Is the other way around. This is 12% coupon. Interest rate is 10%. Okay, this is wrong actually. Okay, this one is actually 12. I cannot change here. Okay, but you change yourself. Okay, coupon payment should be 12%. Interest rate remain 10. Okay, so first and foremost, you calculate the coupon payment. 12% times 1,000, which is 120. Okay, and when you do this, you will get that the value of the bond would be 1122.89, which is higher than the par value. So we have three cases here. One would be when the coupon rate equals the interest rate, value equals par value, which is 1,000. When the coupon rate is less than the interest rate, then the value of the bond will be less than the par value. And finally, when the coupon rate is higher than the interest rate, value of the bond would be greater than the par value. Okay. Now, for the second case, okay, this case, when the value of the bond, okay, sorry, here, is less than the par value, we call this a discount bond. A discount to refer that it is issued at a discount to the par value, lower than the par value. Whereas in the second case here, when the value is greater than the par value, it is called a premium bond, because it is issued at a premium compared to the par value. Okay. Now, the rationale issuing at a par or at at a discount or at a premium, okay, um, has to do with the features of the bond. So let's look at the discount bond, for example. Okay, in this case, the discount bond. Now, if you want to think in terms of logic, okay, in terms of supply and demand, right? The prevailing interest rate in the market is 10%. Okay? Meaning this is the interest rate, okay, that are prevailing in the market, okay, whereby as an investor, in general, on average, you can generate this much, okay, this rate of return. Okay? But this company is issuing this bond, right? Is issuing this bond, but it can only pay 8% coupon. Now, you as an investor, okay, if you are looking for the bond to invest, right? The market rate is 10%. The company offers 8%. Would you be attracted or not to buy this bond? By just comparing these two, would you be interested? Anyone?
No, Doc, I don't. No, Doc, I don't think so. This is lower.
Yeah, the market rate is 10%. This company offers 8% coupon. So you would not be attracted, right?
Yes, sir.
Okay. Chances are you would not be attracted unless, in this case, unless if you look at here, it is issued at a premium. Sorry, it is issued at a discount. Okay, at a discount means lower than the par value. Okay? So this, okay, would change the scenario. Okay, whereby as an investor you say, okay, I would tolerate the 8%, okay, coupon rate because the bond is issued at a discount. Okay, I can purchase it at a much cheaper price compared to the par value 877. Why this is important? Why this is attractive? This 877 here. Because later on at maturity, okay, you will get the par value in full, the 1000 maturity value that you will get at the end here, it would be in full, right? So by buying a discount bond, okay, um, you will already, some of your return, okay, component would be from the difference between the purchase price where you buy at a discount, okay, compared to the maturity value that you will get at the end, which is going to be at par value, which is 1000, regardless of what you pay at the beginning to buy the bond. Remember, you understand or not? Okay. So in this case, for this bond, when you buy at 877, okay, what you are entitled to are, okay, every year you will get $80. Every year you will get $80 for 10 years. Okay, so at the end of year one, you will get $80, the first coupon payment. Second year, you will get another $80, second coupon payment, so on and so forth until the 10th year. And on the 10th year also, when the bond matured, okay, you will get the par value in full, the 1,000 here in full. So that is what you get as the bondholder, the one who purchased the bond. Okay? Okay. On the other hand, in this case, so remember this is 12% coupon and this is 10% interest rate. Kita balik the other way around. Okay? So the market rate is 10% and the company is willing to pay 12. So in this case, it's the other way around. Okay? The market rate is 10, interest rate in the market is 10, but the company offers 12% coupon payment, which is higher than the interest rate in the market. Would people be interested or not? Of course, right? People will be interested because this company offer a coupon rate at a higher rate than the prevailing interest rate in the market. But of course, due to the so-called expected demand, okay, due to this attractiveness, this company can afford to issue the bond at a premium. Okay, at a premium which is much higher than the par value. Right? So my question to you would be, okay, this is just to test your understanding so far. If you buy the first bond here at 877.11, as I mentioned earlier, and get this $80 per year for 10 years, and at the end of the 10 year also, you will get this 1,000 par value. My question to you, what is your rate of return or your yield to maturity as a bondholder here, as the one who purchased this bond? You purchase this at 877.11 and you get $80 per year for 10 years, and finally you will get this maturity value. So what would be your overall return, your yield to maturity? Where do we refer to? Anyone? Want to try? It's here somewhere. Where is it?
The yield to maturity.
Yeah. It's here. This 10%.
10%. Okay.
10% is your yield to maturity. Understand or not? So whenever the interest rate given here, the required rate of return, okay, that is the yield to maturity that you plug in, that you use in this formula to replace I here, and I here. This essentially are your yield to maturity. So in essence, the way we look at this particular bond is that there are two ways to look at it. One is what I have asked you, which is when you buy at this price now and get $80 per year for 10 years, and upon maturity, you will get back that 1,000. So what is the return to you, or the yield to maturity is 10%. Okay? Another way of looking at this is, in order for the yield to maturity to be 10%, okay, 10%, for a bond that pays 8% coupon with 1,000 par value and maturity of 10 years, right? How much should it be sold at today at issuance? I.e., what should the value of the bond be in order, okay, for it to have a maturity, a yield to maturity of 10% with all these features? Okay? So it doesn't matter actually, on your perspective. The most important thing is that the interest rate that you use, okay, to calculate the present value here, and eventually will become the value of the bond, right, is the required rate of return for this bondholder, i.e., the yield to maturity. Okay? Similar here. So if you have these two cases, okay, let's say Ashraf buy the first bond, Chandra buy the second bond. So Ashraf buy the first bond, dia keluarkan duit, okay, he fork out money 877 today. And he will get $80 per year for 10 years. And at the end of 10 years, he will get that 1,000 par value. What is the return to Ashraf? Overall, the yield to maturity for Ashraf, 10%. Okay. In another case, Chandra buy this second bond, she pays 1122 today. In return, she will get 120 per year for 10 years. Okay? And at the end of 10 years, she will get that par value 1,000. What would be the yield to maturity to Chandra? 10%. It's the same. Can you see now? Right? The yield to maturity remains the same in these two cases. Right? Even though the price of the bond is different, okay, okay, the price of the bond differs, okay, as well as the coupon payment also differ. So the interaction between these two, okay, would maintain the 10% yield to maturity in both cases. Okay, can you follow so far? Bond um, is basically a debt. Okay? Issuer of bonds basically borrow money from the bondholder, from the people who or the parties who buy the bond, and in return, after they pay the value of the bond, when after the company or the corporation gets the money from the bond issuance, they will have to pay the coupon or the interest payment either annually or semi-annually, right? For a certain period of time, which is called the maturity of the bond. Okay. All right. This is no question. I just continue. Now, another measure that we are interested in is what we call the current yield. The current yield. This is the yield or the return for the bondholders that they will receive or they will get when they purchase the bond. Now, this is different from yield to maturity just now. Okay, yield to maturity, I have explained to you. Okay, the interest rate, okay, respective interest rate, okay, relevant interest rate for the bond issue, bond from the beginning until the maturity, as we have seen earlier. Now, current yield is a simple measure actually, okay, that we calculate by taking the annual coupon payment divided by what would the current price of the bond. Okay, what is the current price of the bond? So in this case, okay, let's look at the question 3 earlier. There are two types of bond, right? So let's look at the one where the coupon payment is 120, okay, and the value of the bond 1122.89. Okay, so the annual coupon payment, you take how much coupon payment is made throughout the year. Okay, in earlier case, it is annual coupon, no issue. Okay, but if it is semi-annual, okay, you have to look at what is the total in the year. Okay, so if semi-annual, you have to multiply by 2 first. Right? So in this case, the annual coupon payment is 120 and the price of the bond is 1122.89. So the current yield is 10.69%. Okay? So what does this entail? Okay? This shows that based on how much coupon you get every year, which is $120, and how much do you pay for that bond? 1122.89. Okay, so what is your current yield? Current here shows if you want to measure at any point of time. Okay, so in this case, for each year, so every year you will get 120. So let's look at this year. So this year you will get 120. How much did you pay for the bond? 1122. So your yield would be 10.69. Now, I want everyone to calculate the current yield for the first one here. Okay. What is the annual coupon? $80, right? Okay. And divide it with the price that you pay for that particular bond. 80 divided by 877. So for this bond, what is the current yield? What is the current yield for the other bond? 80 divided by 877.11. You will get 9 something. 9.112%. Okay, 9.12%. Now, they differ, right? Okay, now it's different. So the current yield for the discount bond is only 9.12%, whereas the current yield for premium bond is 10.69. Even though their yield to maturity earlier is the same, 10%. Because yield to maturity takes into account the entire period from the beginning until maturity. Okay? Whereas the current yield just look at the current year. Okay? You compare the what you get as a coupon payment only, okay? And how much you pay for the bond. Okay? So in this case, it differs. Okay? The premium bond is 10.69, whereas the discount bond is only 9.12%. Now, why do we calculate current yield? There are various reasons. One of them is if you want to compare it with other yields of other investments. So in this case, let's say you want to compare it with um, a stock, for example, okay, that pays certain dividend, okay, and you will divide the dividend, the annual dividend, with how much you pay for the stock. Okay? So let's say the dividend is $1 and you pay $10 for the stock. So the dividend yield in that case is $1 divided by 10 is 10%. So you can compare. You can compare with, oh, if I buy this stock at $10 and the stock pays $1 dividend, my dividend yield will be 10%. Okay, so you can compare it with this 10.69. Okay, what else? You can compare with, say, ASB investment, okay, which is also annual. So the ASB is, let's say, 5%. Okay, so you know your yield, okay, and the annual yield from that ASB investment is 5%. Okay, what else? You go to another mutual fund or unit trust, okay, so on and so forth. So this current yield will help you to compare how much you will get annually from this bond with respect to how much you pay for it. Okay? So that you can make a comparison with other types of investment, okay, for your annual income purposes. Okay? So let's say you manage an investment account, okay, whereby the investor has an objective of diversification, okay, and it wants a variety of investments, okay, to be put into the account, or they have a condition whereby the yield, the annual yield would not be less than 8%, for example. Okay? So in this case, the computation of current yield would help, in addition to not just the yield to maturity that we have seen earlier. Okay, because yield to maturity is from now until maturity. Right? Okay, let's do some practice questions before we go to yield to maturity. Okay. There are 3 questions here that I want you to work out first on your own. Okay. And maybe some of you will share later to the rest. Okay. On the questions. Okay. Start attempting to answer these questions now. Okay, who wants to try? Okay, number 1. What's the answer? Anyone got an answer already for number 1?
So how about 773.97?
773.97.
397.
Okay.
Lesser than pardon.
Okay. Anyone else? You got the same answer or different answer? Anyone got a different answer? Okay. This is a semi-annual. Okay, so if semi-annual, you need to be very careful. Okay, so first you have to establish the PMT first, okay, which is the 8% coupon. But since this is semi-annual, you have to divide by 2 before you multiply with the par value. Okay, so you know your PMT would be $40, not 18. Okay, and for okay, for the period end, so you know that this is 10-year, T is 10-year, okay, but you have to multiply by 2 because of semi-annual. So your period is 20. Then only you build your equation, okay, which is your PMT, which is $40, right? And your formula is 1 minus, okay, remember? Um, okay, before that, your I, okay, I is equals to 8% divided by 2, okay, which is, sorry, 12% divided by 2, which is 6%. Okay, this is your I. Okay, 1 minus 1 plus I is 1.06 straight away to the power of, okay, negative 20. Okay, so all this you divide by 0.06, which is your I, right? And then you close, you keep to the power, right? So do you get this? You have to get this right first. Your PMT is $40. Your I is 6% because 12% divided by 2. Okay? And your N is 20, so to the power of negative 20. Then your maturity value, which is 1,000. Okay? You present value it as a single amount, 1.06, simply to the power of negative 20. And then you use your calculator to calculate the answer. Okay? So did everyone get this?
Wrong at N.
Pardon?
I got wrong at N to
At
get the
N.
N.
Okay, so
Yeah.
you didn't times or
But
multiply
times
by 2.
2. Yes.
6, 40, okay, plus 1,000 times 1.6 to the power of 20. Okay, so it's 770.60. 0.60. Now, first and foremost, after getting the answer, you check, okay, this is lower than par. Okay, so this is a discount bond. And you just check by comparing the coupon rate, which is 8%, versus the yield to maturity or the interest rate, which is 12%. Okay, so definitely this is a discount bond. Okay, right. Okay, do the second one. Okay, notice that the wording of the question over here, it asks you to calculate the value of the bond. What is the value of the bond? Over here, it asks you what is the current price of a bond. They are both the same. Okay? Calculating the value, or calculating the price or the current price, right? It's the same, interchangeable. Okay, the question can use different terms, but it means the same thing. Okay? So in this case, coupon of $45 every 6 months for 6 years. And the yield to maturity is 8%. So notice that the wording here, they use required rate of return. The wording here, they use yield to maturity. Don't be confused, right? It's the same thing. It's the interest that you plug in as I here in your formula. Right? So don't be confused or bombarded with the different terms used. Okay? You should know that it's the same thing. Right? This case, what's the answer? Is this a discount bond or a premium bond? How to know? What is a coupon rate? What is a coupon rate? Anyone? You know that the coupon payment is $45, right? Every 6 months. Okay?
4.5.
Every 6 months.
Eh?
So,
No, no, no.
no, every 6 months. So in a
But
year, okay, you will get
got
twice,
90.
right? Yeah, times 2 is equals to 90. Okay? So to calculate the coupon rate, you know that it is 90 divided by
1,000.
1000. This is it, the other way around. Okay, so you know that the coupon rate is 9%. So for this question, instead of giving you the discount rate is 9%, sorry, the coupon rate is 9% and the bond is paid twice or semi-annually. Okay, instead of phrasing the question like that, okay, the question give you the coupon payment is $45 every 6 months, which if you work it this way, you know that, okay, this is equal to a coupon rate of 9%. And the coupon rate of 9% is higher than the yield to maturity or the interest rate of 8%. So you know that this is a premium bond. Okay? So when you work out the calculation, okay, so your PMT is easy, already given $45. Okay, every 6 months. You know that this is 1 minus. Now, the yield rate is 8%, but since this is a semi-annual coupon, so you have to divide by 2. Okay, so 1.04. Okay, to the power of, okay, 6 years times 2 would be negative 12 here. Close divided by 0.04. Subscript this one. Close. Then plus your maturity value standard 1000, 1.04 to the power of negative 12. Okay. Check again, PMT is correct, 45. Okay. And this is semi-annual, so the interest rate you have to divide by 2. Okay, correct. 4% here, 4% here. And for N, okay, the period, this is 6 years. Since this is semi-annual times 2, so there are 12 coupon payments. So to the power of negative 12 here, to the power of negative 12 here. Okay, and you use your calculator to get the answer. Okay, do you get 1046.93? 046.93. Did you get that? Make sure everybody gets it first. The way I do it, because I'm using my iPhone calculator. Okay, the easiest way would be for me to calculate this first. Okay, and then I divide by 0.04. Okay, equals to, and then I multiply by 45. So I will get the answer for this first term here. Then I simply just, it doesn't require memory in or memory recall here. Okay. Whatever I get here, I simply plus straight away 1000 times 1.04 to the power of negative 12, and it will give me this answer without even I need to write down or need to store in memory whatsoever. It's just a single straight one operation using the scientific calculator. Okay, I notice in your quizzes for the time value of money questions, some of you did not use the memory function. So you just write in the long numbers, okay, or you simplify it using short decimal places, which I did not finalize, but it doesn't give the most accurate answer, right? Everybody gets this?
Ya, Doktor.
Right. So now calculate the current yield for both bonds. Okay, so the current yield for the first bond, what is the, okay, this is a mistake many students make, okay, when I ask this current yield. Okay, so they quickly want to answer. So they look at question number one, they look at the coupon is $40. Okay, they calculated this now $40, or in this case, they tengok coupon is $45. So they straight away put 40, divide by what is the price, 770.60. Okay, and they calculate the answer, which is wrong. Remember, for current yield, you need your annual coupon. Okay, so over here, you calculate the semi-annual coupon to calculate the value of the bond. But for current yield, you need your annual coupon figure here, $80. So it's 80 divided by 770.6, okay, which is 10.38%. Okay. While for the second bond is annual coupon is $90, okay, because $45 every 6 months divided by 106.93. Okay, so 90 divided by 1046.93, it's about 8.6. Okay, 8.6%. Okay, so far okay? You can follow, right?
Yeah.
Right. So let's move on to yield to maturity. Stop here first. Okay. Right. Let's take a 5 minutes first, because this is quite heavy. Okay, so I need to sink in whatever that you have learned previous up until now. Okay, let's take a 5 minutes, wash your face or go to the restroom first, and come back after 5 minutes.
Ya, Doktor.
Right. Okay, let's continue. Okay, next, we're going to explore the yield to maturity. Okay, I have along the way, okay, from the start, keep on repeating what yield to maturity is. Okay, and it is the rate implied or the rate of return that the bondholder would generate or would get by buying the bond, okay, and hold on to the bond until maturity. Okay. And another name for it is we can also call this the required rate of return to the bondholders, okay, or simply just the interest rate, okay, the prevailing interest rate of the bond. Okay. Now, what it means is that, okay, based on the earlier questions that you are solving to find the value of the bond, the interest rate is given, okay, alongside with the maturity period, the coupon payment, and you solve for the value of the bond. In this case, okay, what happened is that the interest rate is not given. You have to solve for the interest rate, i.e. the yield to maturity, upon knowing the value of the bond, coupon payment, and the time period. So if you can still remember, this is similar to solving for interest rate, okay, in the time value of money, okay, for annuity, okay, in the quiz question earlier and the examples that I have given. Right? So using similar kind of operation, okay, we will start off with trying. That's why the trial and error there. Okay, trying at a certain rate first, then proceed with the interpolation. Okay, so some textbooks they call it trial and error, or some would even suggest, of course, using financial calculator, okay, which is much simpler, okay, easier, or using the Excel. Okay. But of course, the purpose of this course is to expose you with how to solve this manually. Okay, and I'm using the interpolation technique, which I have taught you earlier in time value of money. Okay. So let's look at the example straight away. Okay, consider a bond with a 10% annual coupon rate, 15 years to maturity, par value 1,000. And it's given that the price of the bond is 950. So you already know the value of the bond. So with this value of 950, 10% coupon rate, 15 years to maturity, what would be the yield to maturity of the bond? Okay. Now, first and foremost, okay, you calculate the PMT first. The coupon payment is 10% times 1,000 is 100. Okay. T is 15 years. Value of the bond is 950. To begin with, okay, this is the most important starting platform, which we have seen earlier. You know that at an interest rate or yield to maturity that is equal to the coupon rate, okay, the value of the bond will be equal to the par value, which is 1,000. So this you know. Okay, so this will help you to start answering this question. As I said, this is what we call the starting platform, okay, to answer this yield to maturity question. So this one is automatic, you know, at interest rate I, which is YTM, which we will solve later. Okay, at interest rate of 10%, which is equal to the coupon rate of 10%, you know automatically that the value should be 1,000. Now, question is where to go from there? Okay? Where are you going? You are trying to solve for interest rate, okay, for this value, 950. So 950 is lower than 1,000. Okay? So you know that at 10% value is 1,000. So you ask yourself, what would be the interest rate, okay, for a value of 950? 950. Okay, so from 1,000 to 950, it will go down, it will decline. Okay, the value will decrease from 1,000 to 950. So this will help you to choose what rate to try, what will be the first rate to try. So you know that from 1,000 to go down to 950, you know that the interest rate has to go up from 10% to some rate. So in this case, since the difference between 1,000 and 950 is so small, just $50. Okay, so you will try at a rate which is not far different from 10%. So in this case, I use 11%, okay, as the first rate that you should try. Okay, so you try at 11%. Okay, but of course you have to change, okay, the interest rate here, 1.11. Okay, this is you have to divide by 0.11. So you make a correction here. This is not complete. Okay, I copy this into the word. Never mind. So you know that this is 1 minus 1.11 to the power of negative 15 divided by 0.11 first. So I missed this one inside here. Okay. Before you add 1,000 times 1.11 to the power of negative 15. Okay. And at 11%, the value is 928.09. So now ask yourself, can you start doing the interpolation or not? Yes, you can. Why? Because you have this value at 10%, which is 1,000. You have at 11%, 928. And 950, the one that you want to solve the YTM for, is sandwiched between these two figures, between this 1,000 and 928.09. So you arrange accordingly. Okay. At 10% earlier, the value is 1,000. At 11%, the one that you try here is 928.09. So you are solving for this YTM, okay, which will give the value of 950 in the middle. Okay, so using the interpolation technique that we have seen earlier, you know that 0.1 minus YTM here divided by 0.1 minus 0.11, which is here, equals to the right hand side, which is 1,000 minus 950 divided by 1,000 minus 928.09. Okay, the rest are mathematical, okay, as I have shown, and you also have gone through the calculation of this interpolation. So solving for YTM, you will get 10.7%, and you check to ensure that 10.7% is indeed sandwiched between 0.1 and 0.11. So this will be your yield to maturity. So in essence, okay, for this particular bond, where it pays 10% coupon rate, annual coupon rate, and 15 years to maturity with a par value of 1,000, and if you purchase it at 950 now, right, and you hold on to the bond until maturity, the yield to you, which is the yield to maturity, would be 10.7%. Okay, did you get this so far? Right, so this 10.7% yield to maturity stands if you purchase it at 950 now and you keep the bond, you hold on to the bond until maturity, which is for 15 years. And along the way, you will get that $100, 10% coupon payment, $100 per year for 15 years. And upon maturity, you will get back the par value, which is 1,000. Then the yield to maturity to you as the bondholder would be 10.7%. My question to you is, if let's say, okay, you don't hold on to the bond until maturity, okay, let's say after 10 years, you sell the bond. Okay, after 10 years. So you don't keep it until 15 years. You sell the bond after 10 years. Would your yield to maturity still be 10.7%? Would it still be 10.7%, your yield to maturity, if you don't keep it until maturity?
No.
Yeah, no. Okay, the answer would be no. So your yield to maturity will not be 10.7 in that case. Okay, so you have to digest that. The only way you can get or you will get that yield to maturity of 10.7% is if you purchase it at this price, which is 950, get this annual coupon of 10%, which is $100, and you keep it for 15 years until maturity, in which you will also get that maturity value or par value of 1,000 at the end. Then only your yield to maturity would be 10.7%. You get that, right? Okay, so that is very important. Okay, because later you will face a situation where somebody do not keep it until maturity, or somebody come in later. They don't purchase it at the beginning at 950. Maybe 2 years down the road, or 3 years down the road, right? The bond exchange hand, and somebody come in and buy the bond from you at a different price. Okay, so let's say 3 years down the road, or after this bond has been issued, right? This bond is sold to another investor at a certain price. Okay? In which case, if that person comes in, okay, 3 years later, he or she will, let's say, we assume, hold on to the bond until maturity. So the end would be different, not 15 years. Their end would be 12 years because they comes in 3 years later. So from that point until maturity is only 12 years instead of 15 years. Right? So those are some complications that you may or may not see later. But for now, okay, what I hope you can understand is that, okay, for this particular yield to maturity to be effective, okay, you need to meet these conditions. Buying at 950, getting 10% coupon rate, and hold on until maturity, which is 15 years. Okay, let's do this exercise. Yeah. Okay, make sure you go through the process of doing the question. Don't just simply okay. Suppose a bond with a 10% coupon rate paid semi-annually, okay, has a face value of 1,020 years to maturity and is selling for 1,150. What is the yield to maturity of the bond? Okay, what should you do first? How to start, how to begin? Anyone? Any suggestion? How to start answering this question? You begin with what? Calculate your PMT, right? The coupon payment. Okay. So it's 10%. Because this is semi-annually, you have to divide by 2 before you multiply with 1,000. Okay, this is equals to $50. right? Then what? Okay, what is your N? $20, first semi-annual,
40.
40. Okay, what else you need to know? That's all, because you have to solve for the interest, right? Okay, and you know that the value of the bond is, okay, 1150. Okay, all right. So what is your starting platform? The most important starting platform. Okay, at I equals 10%. Why 10%? Why do we equate it to make it equal to 10%? Because we want to make it equal to the coupon rate here, 10%. Okay, so at I equals to 10%, you know that value of the bond definitely would be 1,000. Okay, then you look at the direction where to go. Okay, you need to solve for yield to maturity for the value of 1150. So 1150 is higher than 1,000, right? So if it is higher, so you know that the next rate that you want to try would have to be lower than 10%.
10%.
Okay, so we try at a lower rate. Okay, let's say we try at 9% first. Let's say we try at 9. Okay, 9%. Okay, what would be the value of the bond? So the PMT is $50. 1 minus, okay, 9%, okay, is 0.09. Don't forget to divide by 2 because this is semi-annual here. Okay, 1 minus 1.045 because 9% divided by 2. Right? Okay, to the power of your N is 40. Okay, so to the power of negative T, so altogether divided by 0.045. Okay, do this first. Superscript. Okay, this is the first term. You don't forget you have your maturity value, which is 1,000. 1.045 to the power of negative 40. And you find this value first, okay, and I equals to 9%. Right? Okay, everybody get the answer? 1092.01.
Yes.
Did you get this?
Yes.
Okay, everybody else?
Okay.
All right, good. Okay, what do you do next? Can you stop and start doing the interpolation just yet?
Cannot.
Okay, not good. Why? Because the
Because
value is still
not between.
can or cannot.
Cannot. Value still not in between
At
10 and 9.
10% that you tried earlier, you
Value
know
still
that
higher.
10%, is 1,000. You are solving for, okay, a value yield to maturity in which the value is 1150. Okay. So at 10%, you know, is 1,000. When you try at 9%, okay, it is 1092.01. Okay, so it still doesn't exceed 1150. So you still cannot do the interpolation, right? So no choice. Okay, you have to try another rate, but don't go too far because from 1092 to 1150, it's only okay, 1150, about $60 like that. Okay, so you try at the next rate, which is 8%. Okay, let's try at I equals to 8%. So your value would be $50. Okay, you just copy this one, but you replace this is 0.04. Here, 0.04, 0.04. Okay, don't forget. Equals to, okay, now try at 8%. Okay, what did you get? Did you get 1197.93?
Yes, Doctor.
Okay, good. The rest, make sure you get, because this is practicing. Yeah, I think you have this opportunity to practice
Dapat, Doctor.
outside of time. I think I know it's difficult for you because you're busy working with your family, and so take this opportunity to practice as well. Okay, now since you know that you have these two figures, okay, 1092 and 1197, in which 1150 is sandwiched between these two. So you can start, okay, doing the interpolation already. So you know that, okay, in using the interpolation, okay, don't take this 10% at 1,000. We take the 9 and 8%. It will be more accurate. Although you will still get the answer if you use, you interpolate between this 10% 1,000 and 8% 1197. But taking 9% and 8% would be more accurate. Okay? So at 9%, the value is 1092.01. Okay, this is the YTM that you want to solve, in which the value is 1150. And at 8% just now, you get 1197.93. Okay. So you know that the difference between 9% and YTM divided by 0.09 minus 0.08 equals to 1092.01 minus 1150 divided by 1092.01 minus 1197.93. Okay. Okay. So the difference between, if you look at the denominator down here, okay, the difference between 1092 and 1197 is negative 105.92. Okay. The difference between these two is negative 105.92. Then the numerator here, 1092.01 minus 1150 is negative 57.99. So this negative 57.99, you divide by the numerator just now, negative 15 something, divided by memory recall, you will get 0.5474. Okay, 0.5474. And this 0.5474 that you will get, you know that based on cross multiplication that I have explained to you last time, you multiply by this difference here. Okay, 0.09 minus 0.08, okay, which is 0.01. You multiply by 0.01, so it will give you 0.00547 something, right? So you know that that figure is to be deducted with 0.09 here. Okay, so you do that and you will get the final answer to be 0.08453, okay, which is 8.453%. Okay, and this figure, make sure that it is indeed in between, okay, sandwiched between 8% and 9%. Okay, most important thing is for you to establish this interpolation equation. Okay, and the rest are mathematical, right? Make sure you calculate it correctly. Okay, if you are not confident of doing as what I have shown you, you do it step by step. Long way pun tak apa. Even if it takes you a long calculation, just to be safe. If you're not confident, so you just do it step by step lah. Meaning step by step, what I mean is that you just do like this. Okay, divided by 0.01 equals to, and then you calculate what is the numerator first, okay, which is 1092.01 minus 1150, okay, which is negative 57.99 divided by, then you calculate the denominator, which is 1092.01 minus 1197.93, okay, which is negative 105.92. Okay, over here, don't make the mistake of straight away do the cross multiplication. Some students they do that, so they know that this is A divided by B equals to C divided by D. Okay? So what they do is this A here, they multiply by this denominator here, and this one they divide, they multiply with this one. That will be complicated. Okay? The easiest way would be for you to calculate this one first. The negative 57.99 divided by negative 105, like I did. Okay, so if you do this slowly, you get equals to, so you calculate the right hand side first, okay, which is 57.99 divided by 105.92, okay, which is 0.54748, okay, etc. Then only you cross multiply. You multiply the 0.54 with 0.01, okay, and so on and so forth. Okay, so if you're not confident of solving it right away from here using your calculator, you just write down step by step lah, okay, until you get the answer. Problem. Okay, any question? Of course, if I ask this in your exam, right, you can, for those of you who have financial calculator, you can even use Excel. Okay, you can use your financial calculator as Excel as a double check lah, to ensure that your answer is correct. But for exam or test purposes, I need to look at the working. Okay, I need to look at, because marks will be given on your working, on your step, because this shows your understanding of what YTM really is. Of course, using financial calculator and Excel, you can get the answer, right? But use the calculator and also the Excel to check, to ensure that your answer is correct. But I need to see the workings, right? Okay. Okay. You can also have a case where you will encounter what we call a zero coupon bond. In this case, there is no coupon. Okay, there is no coupon payment every period. It's just simply a bond is issued, right, at the par value, and um, with no coupon payment. Okay, so what it entails is that when you buy the bond, from now until maturity, you didn't get anything. Okay, it's just that upon maturity, when the bond matures or expired, you will get back the par value. You will get the par value of 1,000, right? And a certain interest rate is prevailed. So in this case, let's say the interest rate is 12%, and it's a 15-year zero coupon bond with a 1,000 par value. Okay? So in this case, it's a very simple calculation because there is no coupon payment. There is just this 1,000 par value as a single amount that you will get upon maturity. Okay? Right, so this 1,000 is discounted at 12% because the YTM is 12%, and to the power of negative 15 because of 15 years. So the value is 182.7. So in this case, it is much more straightforward in the sense that for this zero coupon bond with a value of 182.7, a person who purchased this bond at 182.7 will not receive any coupon, but after 15 years, at maturity, will get the 1,000 par value. So um, the return to you would be in terms of the difference between how much you pay, which is 182, and how much you will get at the end, which is 1,000. And in this case, the yield to maturity for this particular bond holder is 12%. Meaning by buying at 182, okay, and after 15 years, you get back that 1,000, right? Examples of zero coupon bond would be treasury bills. Okay, this is a form of bond, which is actually a money market instrument that is issued by the government through Bank Negara or through the central bank. Okay. Now the rest you can read on your own. Okay, on the terms and condition. I mentioned this indenture, which is an agreement, right? So these are the features, okay, among the provisions that are put forth in the agreement, or the in bond we call it indenture. Okay, there's a special term used for bond. Okay, indenture. What are the terms, the amount issued, okay, and if there are security or some sort of a collateral, okay, or the underlying asset used to back the bond. Okay, you have to describe the assets or the property, and what are the arrangements for repayment. Are there any call provisions? Call provisions mean the issuer can call the bond even before maturity. Okay. Now the basic idea is if you issue a bond and if it has 10 years to maturity, when you purchase a bond, you can hold on to the bond until maturity, which is 10 years. But if there is a call provision, then the issuer of the bond can call. Call means uh, uh, they will buy back the bond from you. Okay, so you will cease to become the bondholder. Okay, along the period, even if before maturity. So let's say originally the maturity is 10 years, but let's say after 5 years, right, due to the change in interest rate, so it will be better for the company to stop, okay, the bond. So they will call the bond. Call the bonds means they will pay you the maturity value, okay, and you will stop getting the coupon payment. So you will have to surrender the bond to the company. Okay. So certain bond has this provision. Certain bond do not have this provision. If you do not have the provision, means the company cannot stop, cannot call the bond. Okay. So the value of the bond will depend on whether or not they have this provision. The other one important aspect would be what we call the protective covenants. Okay. Protective covenants are features that are put into the agreement to protect the bondholder. Okay? Because at times there is a conflict between the shareholders and the bondholder, and there are certain features that may result in a disadvantage to the bondholder, okay, or advantages to the shareholder, but at the expense of the bondholder. So, in order to protect the bondholder, there are certain protective covenants or protective terms, okay, and conditions being put forth in the agreement or the indenture. And again, that will affect the value of the bond at the end. Okay? So there are quite many other complications and also complexities, advancements, right, being uh, created in the bond markets as far as bond or sukuk are concerned. Okay? So the rest you read on your own in terms of what are the government bonds, examples of government bonds. Okay? These are issued by the government. Okay? But majority of the bonds are issued by corporations. So they are called corporate bonds. Okay? And the difference would be in terms of risk. Cost bonds issued by the government are less risky compared to bonds issued by corporate or by corporations. And those raise as well as the financial standing and credibility of the corporations that issue the bond will affect the rating, okay? The rating of the bond. So every corporation are rated, and hence the bonds they issue are rated accordingly, parallel to the rating of the company. Okay? So basically we have four types. We have high grade, medium, low, and very low grade. Okay, and even companies with low rating, okay, they still issue bond. Okay, they are still allowed and they are still market where the bonds issued by low rated corporations, okay, are still issued. Now, my question would be, okay, now first question before we go on, what do you think would be the main difference between uh, bonds that are issued by high grade or high rated company, hence a high grade rating bond, compared to a low graded or low rated bonds? What is the main difference? it is shown here actually, capacity to pay. This capacity to pay is reflected by the strength of the company that issue the bond. Okay, so we are talking about the probability. Okay, so if it is a highest grade, okay, say kalau if we use Moody is triple A, okay, with big letter and two small letter, or if it is Standard and Poor's, we use a triple A in all capital. So the difference between this triple A bond and let's say we compare with a D, C or D graded bond is in terms of the capacity to pay the coupon payment. So in this case, the probability is high for them to be able to pay without any problem. Okay? And the probability of default is almost zero. Okay? Almost 0%. Whereas for a lower grade, say a D, the probability of default is high. Okay? Say 40% or 35% probability of default, meaning the company would not be able to pay the coupon payment. Okay. Okay. Now, with that in mind, my question would be, if let's say there is a company in this range, okay, in this grade, wants to issue and it issues, do you think there is a market? Do you think there would be buyers, people or companies that would be interested to buy or to purchase these very low grade bonds? Even if, knowing the fact that the probability of default is considerably high.
Maybe ada Doktor.
Why is it? What
Why?
would be the rationale? How to explain?
Kalau dia default, apa jadi dengan
Yeah,
orang?
they will not get the coupon. But the trick is this. Okay? The low graded bonds would have to be issued at a high coupon rate. Coupon rate for low graded bonds are much higher than the high graded bonds. Okay, so for example, we look at the Petronas bonds or Sukuk, which is only at say 6% coupon payment, as opposed to a low graded bond, the counterpart would be 12% or 14%. Okay? The reason being, the high graded bonds can afford to pay lower coupon rate because the demand, okay, for high graded bond is high. Okay? Then inversely, the demand for low graded bond is low, right? But there are still a market, normally the underserved market, that would be interested. Okay? The underserved market normally would not be able to buy the high graded bonds, and they want to take the chances or the opportunity for the high return offered by the low graded bonds. Of course, there is a possibility of default. They have calculated that. Okay, but the high return offered compensate the risk that they take in buying the low graded bonds. And in fact, many studies have been conducted in the US, especially on these low graded bonds. Okay? So overall, even though there were evidence of default over the years, but if you take the average, if you take the big picture as a whole, it is quite lucrative in the sense that the figure they use is about 70 to 75% success rate, meaning those who purchase would eventually get the high coupon rate, and only 30 to 35% possibility of eventually do not get the full coupon payment. And to them, overall, this is considered okay, right? Considered okay because if we take the whole average, it is still lucrative. And remember, in the market, there are various segments. Okay? There are segments of financially high companies with a high financial standing or high status, which would, of course, go into only high grade or medium grade. And there are segments which, would look for this low grade and very low grade, as I said, particularly to capitalize on the high returns offered. Okay? So in bonds is the other way around. If you are high grade, high financial standing, then the coupon rate is normally low. Okay? But if you are low grade, okay, sometimes we call junk bonds, the yield to maturity or the return is high. So it's terbalik. It's the other way around. Later on, when we go to stocks, it's different. Okay? For stocks, it's different. But for bonds, because it involves um, the notion or the term is borrowing. So in this case, when company issue bond, it actually borrows money from the public. Right? So if you are a high financial standing company, right, you have the luxury of um, being able to borrow at a low rate. And even if you offer a lower coupon payment, you will still get buyer. You will still get investors interested because your capacity to pay is extremely strong. This is a sure investment. Okay, they will surely 100% get the coupon payment every period from you. And also they want to um, bank, they want to capture or they want to benefit from your financial standing. Being able to be a bondholder of a strong financial standing company. So that is what, because the bond rating concept sometimes confuse people. People say that why does high grade bonds offer lower coupon payment than the lower grade bond? Shouldn't it be the other way around? No, for bond is different. Okay? All right. Okay, these are among the factors that can affect the default risk as well as the bond rating. This one is used by the rating agency, okay, in order to rate the bonds. Okay, and this is the bond market, okay, in Malaysia, and this is a side discussion on the concept of real interest rate and nominal interest rate, where real interest rate already takes into account the inflation, whereas the nominal has not taken into account the inflation. So that's why when you look at the rates, you have to be very careful to see whether it's nominal or real, okay, and whether or not interest rate has been compounded or has been factored into the rate. Okay, so this is just the relationship between inflation and interest rates, and this is the determination of bond yield. There are three main factors, okay, as discussed earlier, which is the real interest rate, okay, inflation, and also interest rate risk. All right. Okay, so we are done with bond. Okay, valuation. Any question?
Doctor,
Yeah.
so saying that bond is a low risk investment tu tak accurate lah.
Low risk investment meaning?
I mean purchasing a bond consider a low risk investment
It's not lower. Yeah.
because of the
We can't
rating kan
say
macam
that
ada.
in general. We can't say that in general. But if we were to compare um, on average, apple to apple, okay, bond versus stock in terms of raising capital. In terms of if a corporation or a company want to raise capital and they have the option of going into the bond market by raising or issuing bonds compared to going to the stock market, then the bond option would be considered as cheaper. Okay? Cheaper, that is in terms of pricing. But in terms of risk, that depends also. If they purchase the high graded bond, then the risk will be low. If they go for low graded bonds, then the risk will be high. Similarly, if they issue stocks, okay, for example, but the stocks is different scenario. Okay? Stocks would be you have to pay dividend, of course, to the shareholder, but the difference between dividend payment and interest payment for bond is that for bond, the interest payment is compulsory. Okay? It is, you have no choice. It is obligation. Much like you borrow money from the bank, right? You have to pay interest every month. Similarly, if you issue bond, you have to pay coupon or interest to the bondholder. That is stated by contract, okay, in the agreement. But for stocks, it's a little bit different because the dividend payment to the shareholder is optional. It is not compulsory. It is not mandatory. Okay, so when we go on to the stock chapter topic afterwards, then you can see the difference between the two. All right. Okay, we take a lunch and prayer break. First, we come again at 2. Right. Okay, we continue on with the stock valuation. Okay, this is a follow-through topic. Okay, after we have covered the bond valuation earlier. Okay, and based on the basic valuation concept that I have explained earlier, right? We are still looking at the cash flows. So in the bond case earlier, okay, we look at the coupon payments and also the maturity value of the bond as the relevant cash flows on which we perform valuation on the bond. Now for stocks, okay, theoretically and in many textbooks, right, we use dividends. Dividends are considered to be the cash flow series, okay, for stocks, even though, as I mentioned earlier, dividend payment is not obligatory, and some companies don't even pay dividends, and some companies do not pay dividend regularly, for that matter. But for theoretical purposes, okay, the finance academic pioneers use the dividend discount model, okay, to perform valuation on stocks. Okay, now they build the model under the um, uh, assumption that even if, okay, the company does not pay dividend, right, or does not pay dividend regularly, okay, what the dividend um, entail is the cash flow capacity of the company. And then later on, we have a few other scholars who have developed more modern techniques, valuation models and techniques which do not rely solely on dividend. So they use, say, for example, the free cash flow, okay, or simply the cash flow streams of the company to perform valuation on the stock, okay, of the company. But the essence is cash flow, right? And for stocks, it's a little bit different because it does not have a maturity period, unlike bonds. So that's why bond is a little bit straightforward because you know when it ends. Okay, but for stocks, whenever you purchase a stock, right, you can hold on to it almost forever. Okay, you can hold on to it for 30 years before selling it, or you can hold on for a week. It doesn't matter, right? It is not the same as bonds earlier, because bond has a maturity period. Okay? But that is not the case for stocks. Now, what we're going to look at is basically we're going to start off with dividend discount model. Okay, we're going to start off with the constant growth model and then the multi-stage model. Okay? And later on, this is a bonus. I add on to the cost. We use the price earnings ratio technique, right? But we relate it to the dividend discount model nonetheless, right? And particularly focusing on the growth component of the company. Okay? So, so we have in the dividend discount model, we have the zero growth scenario, okay, constant growth, and differential growth, which is the multi-stage dividend model. Okay. Let's start with the zero growth first. Okay. Zero growth is the simplest, the most basic. Right? Over here, okay, companies pay dividends, but the dividend level is the same, meaning that it remains level, the same level forever. There is no growth. Okay. Notice that not the dividend that is zero. Okay. We have a value for dividends. It's just the growth is zero. There is no growth. Okay. So let's say a company pay a dividend of $1. Okay. So they will pay consistently every year $1, $1, $1, $1. So the growth rate is zero, not the dividend zero. The dividend is $1. Okay. So differentiate between the zero payment and zero growth in the dividend payment. Okay. Now, since future cash flows are constant, right, it's the same level of dividend payment. So if we want to value this stock using the present value model, it is a present value of a perpetuity, okay, that we have seen earlier. Why perpetuity? Because it's a perpetual dividend payment, okay, which is the same every year, forever. Okay? So if it is a perpetuity, then we apply the formula that we have seen earlier. In this case, the numerator is the dividend amount, say $1 just now, and divided by K. Okay. In stocks, for the discount rate, we use a return, okay, which is called the required rate of return to the stockholders. And it is denoted by K. Some books use R, okay, it doesn't matter. Okay, but many books use a K to denote the required rate of return to the stockholders. So if K is given and we know how much the perpetual dividend amount is, then we can calculate the value of the stock, which is denoted as P. P is to stand for the price, the stock price, the stock value, and not here is it means now, okay, at time zero. Okay. Another term to use for the stock value or the price is what we call the intrinsic value. Okay. Intrinsic means the theoretical value. Okay. What would be the theoretical value of the stock that pays this dividend and with this required rate of return? Okay. So for example, this company pays a constant dividend of $1.20 per year. So you know it's a perpetuity. It's constant dividend means zero growth, no growth. Okay. The required rate of return is 10%. So the value or the intrinsic value of the stock is simply 120 divided by 10%, $12. So if the investors or the stockholders require a 10% rate of return, and this company pay a dividend of 120 perpetually in perpetuity, so the value, the intrinsic value is $12. Meaning to say that if, let's say, the stock is traded at, let's say, $13 or $14 in the market. So this particular investor with a rate of return of 10% knows that $13 or $14 is not worth. It's not worth a buy, right? Because the intrinsic value to him as an investor with this required rate of return is $12. But if in the market, okay, the stock is traded at, let's say, 11 or $10, then it will be a good buy, okay, meaning that it is undervalued, okay, and it is worth the money, worth to buy the stock. Okay, next case is we go on a constant growth scenario. Okay. Now, there is a growth, the dividend will grow, okay, every year, and the rate of growth or the growth rate is constant. Okay. So it is not the dividend amount that is constant, it is the rate at which the dividend grow that is constant. Okay. The growth rate is constant, right? So if we have this, if we look at the formula, okay, so in the first year, the dividend is dividend 1. Come the second year, it will grow by G, growth rate. So you multiply dividend 1 with 1 plus G. Based on time value of money, you know already why we use 1 plus G, because this is a growth factor or the compound factor for the dividend. Now come second year, okay, sorry, come the next year, okay, this is the first year, okay, the second year is plus 1 plus G, multiplied by 1 plus G. Come the third year, dividend in year 2 earlier, you multiply by another 1 plus G. So notice that the G, the growth rate is constant, okay? But the dividend will grow by that function, by that growth, okay? That constant growth rate. Okay? And to find the value or the intrinsic value, we present value each dividend respectively. So in year 1 to the power of 1, or using the approach that I have taught you, it is dividend 1 times 1 plus k to the power of negative 1. Over here, if we bring it up, it becomes times 1 plus k to the power of negative 2, etc. Now, if we continue on, and let's say this doesn't end, okay, it is infinitely or for a very long time, okay, we can actually simplify all this. Okay, so this Professor Gordon, okay, has actually done this many years ago. You can actually simplify this into this simple formula here that you see. Okay, so if dividend is growing at a constant growth rate G, okay, and K is the required rate of return for stocks, you can simplify. You can know the current value or the intrinsic value of the stock by taking the first dividend, okay, dividend in year 1, divided by K minus G. K is the required rate of return. G is the constant growth rate. Okay. Now, this knowing dividend in year 1, okay, which will start to grow at a constant growth rate forever, we can know the current stock price, which is P0, P0. This is important because later on, we will see that, okay, dividend can start growing at a constant growth rate later, maybe starting in year 4, for example. So if that is the case, if let's say dividend will start growing at a constant growth rate in year 4, then we are able to calculate the price of the stock in year 3. Okay, you see the logic here, where I'm going? Okay, 0 here because dividend will start growing constantly at a constant growth rate starting year 1. If dividend will start growing at a constant growth rate in year 5, then we are able to calculate P using this formula in year 4, P4. Okay, so you can replace this. Knowing dividend will start growing at year 6, at a constant growth rate, we are able to calculate P5, so on and so forth. Okay, so let's look at this example straight away. Okay, take the bold corporation that we use this one just now. This is the base case. Okay, now assume that this company wishes to increase its dividend by 5% per year forever. Okay, meaning that starting the first year, they want to start increasing the dividend. What is the growth rate? 5%. So 5% is your G, the constant growth rate. Okay. What is the K, required rate of return, given earlier? 10%. Right? So with this info, okay, what you do is, remember the formula? D1 divided by K minus G. What is your D1? D1 is 120 times 1.05. Okay, why you need to calculate 120 times 1.05? Because 120 is not D1. 120 was D0. Okay, D0 pays a constant dividend of 120 per year. Okay, starting now. So end of the first year, which is D1, you have to increase it by 1 plus G, which is times 1.05. Then only this whole thing becomes D1. Then only it is applicable, okay, to this formula D1 here. Divided by K minus G, K is 10%, the constant growth rate is 5%. Okay, so in this case, the intrinsic value of the stock is $25.20. Okay, notice that if you compare this with the earlier case, okay, the earlier case was perpetual, right? The dividend is the same every year, 120. So the value of the stock is only $12. But now, since you have this scenario where dividend will increase by 5% per year, the intrinsic value increased to be $25.20. Okay, of course, it is much higher. Okay, and the difference comes from the 5% growth of dividend forever. Okay, right. Practice question. Okay. This company is expected to have dividends grow at a constant rate of 6% for a foreseeable future. Various terms are used: infinitely, forever, for a very long time, for this foreseeable future. They all mean the same. It means that you have to apply this constant growth rate formula, which is the Gordon, okay, Gordon constant growth model. P equals to D1 divided by K minus G. Okay? Now, if this company just paid a dividend of 281 and its level of risk requires a discount rate of 10%, what is the intrinsic value of this stock? Let's try this one. Okay. So first, your clue is at a constant growth rate of 6%. So you know, okay, you have to use the constant growth dividend model, right? Where P not equals to D1 divided by K minus G. Okay. You start with the formula first, right? Okay, now What is your G? You know your G is 6%. Okay, this is your constant growth. Next, you need to find your, okay, you know your K is 10%. Okay. So what is your D1? What is your D1? Anyone? What is your dividend in year one?
0.8.
Pardon?
2.8.
Okay. 2.81 is D0. Okay. The clue here is just paid. Just paid means it is D0. Okay. So your D1, what you need to do is you need to find, okay, it's actually D0, okay, 1 plus G. Okay. So in this case, 2.81 times 1.06, right? It becomes 2.226. Right? Sorry. 2.81 times 1.06 is 2.9786. Okay, so it is 2.9786. Okay, many students got wrong here where they immediately take this 2.81 as D1 and they plug in into this formula, okay, which is wrong because 2.81 here is D0, okay, because just paid. Okay. Unless the question is rephrased to if the company will, okay, pay a dividend of 281, right, this year or at the end of the year or at the end of this year or at the end of year one, then it is D1. Okay. But in this case, it is the info here is just paid a dividend, meaning it is something current now, okay, historical, so it's D0. Now you have your D1, you can plug in into this formula, P0, P0. Okay, so your D1 is 2.9786 divided by your K is 10%, your G is 6%. So it's simply 2.9786 divided by 0.04. Okay, it turns out to be 74 dollars and 465 cents. Okay, can you follow this one? This is quite straightforward. Okay, so what we are applying here, okay, basically is the Gordon constant growth, constant dividend growth model. Okay, we call this the Gordon constant dividend growth model. Okay. Key here is the constant dividend growth. The G, the growth rate here refers to the dividend growth, and the growth is constant. Okay. So if let's say 6% here, every year dividend will increase by 6%. Okay. Now the dividend amount is not the same. Okay. Here, for example, dividend in year 0 is 2.81. Dividend in year 1 is 2.9786. Come year 2, you multiply by 1.06, it will be $3 something. So the amount of dividend is not the same, but it is the growth rate of those dividend that is the same. It is growing at a constant growth rate of 6%. Okay. Okay, and the last one for today, okay, we look at the differential growth. Differential growth means there is a multi-stage, at least 2 stages, okay, or more. We can have 3 stage or 4 stage, it doesn't matter, where you start with a certain high growth. Okay, you start off with a certain dividend will grow at a certain high growth for a few years, followed by a much lower constant growth rate forever. And this is more realistic if we want to apply this model to corporations, to companies. Because logically, for many corporations, especially the new ones, the younger corporations, their growth rate in the early years are high because they are growing. But once they become more mature and more stable, then the growth rate will trim down, okay, into a much more stable and almost constant, okay, growth rate for a long period of time. Okay. So in this case, we have 2 stages. First stage will be high growth, and the next stage is followed by the constant growth. Okay. Now, what we need to do is, okay, we need to know the dividend level every year. Okay. We'll draw a timeline, okay, and we calculate the respective dividends. And then for the period where there is no constant growth rate in dividend, we will find the present value accordingly. But the period where dividends will start growing at a constant growth rate, we will apply this Gordon formula, okay, the constant growth rate formula. Okay, let's look at some example. Okay, I think I better use the Word file so that I can easily maneuver. Okay. Now let's look at an example. Now, a common stock just paid a dividend of $2. Okay. Okay, remember just paid just now? So this $2 is D0, okay, not D1. Okay. The dividend is expected to grow at 8% for 3 years. Okay. So the first 3 years, it will grow at 8%. It should add per year, okay, for 3 years. Then it will grow at 4% per year in perpetuity forever. Okay. So another name is infinitely, okay, or foreseeable future, etc. Okay, so various terms are to be used. Okay, discount rate is 10%. Okay, so now what you have is a two-stage, okay, two-stage scenario whereby for the first 3 years the dividend will grow 8% per year. Then it will grow. So the keyword here, then it will grow, means, okay, starting in year 4. Okay, because for the first 3 years, it will grow by 8% per year. The moment you have then it will grow means starting in year 4. Okay, so this is implicit. You can derive this from the sentence, even if the question does not explicitly mention starting in year 4, but you know, okay, because of the word then there. So of course it's after the 3rd year. Okay, so starting from in year 4, it will grow at 4% per year in perpetuity. So you know that later on, you can use the Gordon constant dividend growth model, but you cannot deploy or use the model immediately. You can only use it later because why? Dividend will only start growing at a constant growth rate starting in year 4. Before that, it is growing not at a constant growth rate. It is growing at 8%, but for only 3 years. Okay? So this one is start to grow at a constant growth rate forever. So the keyword there is constant and forever. Okay? Perpetuity. So in order to do this, first and foremost, you need a timeline. Okay? Right? So you not necessarily you build the table here. Okay, just a simple timeline, okay, which marks a 0, and you know year 1, year 2, year 3, and then year 4. Right? So you know that in year 1, year 2, and year 3, okay, the dividends, which are denoted by D1, D2, and D3, are growing by 8%. Then, starting in year 4, dividend will start growing at 4% for how long? Forever. Hence the infinity symbol here. Okay, and so you have two growth rate here. First one, 8% refer to the first 3 years. So the first 3 years, the growth rate is 8%. The second growth rate, which is the constant growth rate forever, is 4%. Okay, so in your timeline, you did 1, 2, 3, 4. Under 1, you write down D1. Under 0 is D0. Okay, D0. Under 2 is D2, D3, and D4. So first you calculate D1, D2, and D3. So you know that D0 is $2. This is given in the question. Just paid a dividend of $2. So your D0 is $2. To find D1, you need to multiply it by 1 plus G. The first G is 8%, so 1.08. Okay. So 2 times 1.08 is 2.16. So you get this bold. Okay, the I bold here is the D1, 2.16. This is the working, right? Next, calculate D2. Okay. There are two ways to do it. Either use the 2.16 you have just calculated as D1 earlier and simply multiply it by 1.08. Okay, so simply multiply 2.16 that you have calculated with 1.08 to get 2.332. So you will get this 2.16 times 1.08, you get 2.332. Or you can use the D0 earlier, $2, multiply by 1.08 to the power of 2. You still get the same. Okay? Answer. It doesn't matter which approach you are more comfortable with, okay, as long as you do it correctly. And then try to find D3, okay, which is 2.2332 times 1.08, which is 2.519. Right? Now, due to the decimal places, okay, sometimes the figure may differ a little bit, but as long as it is within the regime, okay, of the answer, no issue. Okay, I understand because sometimes you take 3 decimal places or 4 decimal places and whatnot, right? So you have 2.16, 2.332, 2.519. Okay, you have D1, D2, and D3. Okay, next, you calculate your D4. And remember, your D4 here is what was the D3. To find D4, I use the slow approach. To find D4, you need your D3, which is 2.519. Okay, but the growth rate now is not 8%. It is 4, Because starting in year 4, the green, okay, color here, starting in year 4, dividend will start increase by 4% per year. Okay, so you will get 2.6197. So I make it to 2.62. Okay. Okay. So you have all the 4 dividends in front of you. Okay. Next, you will need to find the value of the stocks. Okay. But imagine you are standing here at P0. Try to look in front of you and see what cash flows are there in front of you. Okay. So what you have is the first cash flow is D1, 2.16. This is the dividend in year 1. The second cash flow is dividend in year 2, D2, 2.332. The third cash flow is D3, 2.519. And the fourth cash flow is D4, 2.62. Right? Now, my question to you is, do we need to find D5, D6, D7, etc.? Why didn't we continue with calculate D5, D6, dividend in year 5, dividend in year 6, so on and so forth? Why? Why do we stop at D4? Anyone want to try?
Property
Pardon?
after D4.
What did you say?
It
Okay.
will grow 4% in perpetuity until forever.
Okay, then what is the implication? Knowing that info, what does it tell you? We can employ the Gordon
Formula.
constant dividend growth formula, okay, the simplified formula, okay, without knowing and without having to calculate D5, D6, D7, D8, etc. So that is what the Gordon formula uh, uh, function, or how it helps us in that sense. So that's why we stop here. We know, given the fact, we can utilize that formula to help us later. Okay, so you need to find the respective price first. Okay, so as I've mentioned earlier, in the basic formula, P0 here, we are able to calculate P0, okay, if we know that in year 1, D1 would be the first year, right, that the dividend will grow at the constant growth rate forever. Okay. Similarly, if let's say dividend will only start to grow at a constant growth rate in year 4, that enables us to calculate P3. Yeah. So using this info, this logic, come to our problem here. We know that since year 4, i.e. D4 would be the first dividend, where the stock or the dividend will grow at a constant growth rate, that enables us to calculate P3. Okay. Looking forward, imagine you are standing here. So in front of you, in end of year 4, you have the dividend of 2.62. Okay. And this is the start of the constant growth rate, okay, dividend. Okay. So this D4, okay, divided by K minus G, so 2.62, okay, which is here, divided by 10% minus 0.04. Okay, why 0.04? Because this is the constant growth rate starting in year 4. Okay, so 2.62 divided by 0.04 0.06 here, okay, you will get 43.67. Let me check. 2.62 divided by 0.06. Yeah, 43.67. This 43.67 is actually P3, the price of the stock, but at the end of year 3. Remember, from time value of money, end of year 3 means the beginning of year 4. So that's why we put it here. Okay. So now you stand here to calculate the value of the stock and look in front of you into the future. The cash flows that you have in front of you are the relevant cash flow. 2.61, which is D1, dividend in year 1. 2.332, which is dividend in year 2. 2.519, dividend in year 3. And P3, which is the price of the stock in year 3, which is $43.67. So in order to find P0, okay, you discount or you find the present value for each of these 4 cash flow. So the first cash flow is 2.16. You multiply by 1.1 to the power of negative 1. Why to the power of negative 1? Because it is in year 1. So you find the present value of this 2.16 using 10%, the required rate of return, and to the power of negative 1 because year 1. For year 2, the dividend is 2.332. You multiply by 1.1 to the power of negative 2 because year 2. Year 3, you have two things. One is D3, dividend in year 3, which is 2.519. You discount it at 10%, okay, to the power of negative 3. And you have the price of the stock in year 3, which is 43.67, multiplied by 1.1 to the power of negative 3. Now, my question is, and you get 38.59, okay, the final answer. This is the value of the stock, the intrinsic value of the stock today. Why didn't I include 2.62 here? Why didn't I continue 2.62, which is D4, okay, to the power of negative 4? Why didn't I do this? Why didn't I include D4 into the final calculation here? Why didn't I include D4? Anyone?
Because before tu dah lain,
Lain how? How different?
lain the growth rate tu.
No. Whoever
And
got this correct, I will treat a Starbucks drink. I give only 10 to 15 seconds. Why didn't we include D4 here into the final calculation? Okay. Time's up. The reason we did not include because D4 here is already included in P3. Remember what is in P3? In P3, we have D4, D5, D6, D7, D200, D2000, D2 million. Remember the perpetuity, the perpetual forever dividend? So all dividend into the future, starting from year 4, okay, dividend in year 4, year 5, year 100, year 1000, is already encapsulated, already tackled, okay, already taken care, already calculated and represented by P3, which is 43.67. You see? Understand or not? Because P3 we calculate earlier using the Gordon formula. Okay? Under the Gordon formula, we know that if we know, okay, the constant growth rate, okay, and that dividend will grow into perpetuity forever. Okay, forever here. We can simplify this without having the trouble of calculating one by one. We can use this simplified formula. Simply knowing the dividend in year one or the next year dividend divided by K minus G. This is what we did. Okay, this is basically what we did here when we calculated P3. Okay, so all the D4, D5 and everything is inclusive, incorporated here. The reason we in the timeline we calculate D4, okay, is to help us to calculate P3. Okay, but eventually, when you want to find the present value of the cash flows, okay, you use D1, D2, and D3, okay, because these are the years where dividend has not started to grow at a constant growth rate yet. That's why you present value it one by one like this. But starting from year 4, when dividend will start to grow at a constant growth rate, okay, we are able to calculate P3. Why P3? Because D4 would be the first year that dividend will start to grow at a constant growth rate. That's why we were able to calculate P3. If let's say it is not year 4, if let's say only year 5, that dividend will start to grow at a constant growth rate, then we will calculate P4 instead of P3, so on and so forth. So, can you follow so far? This is quite important, but you need practice. Okay? You need to go through because this is a very basic 2-stage only. Okay, first 3 years followed by the constant growth rate forever. Okay, a more complicated would be uh, the first 3 years maybe at 8%, followed by 2 years at 6%, then only, okay, starting in year 7 at a constant growth rate at 2% or 3% maybe. Okay, so in that case, it will be longer, but you apply the same technique. Okay. Okay, let's do this one before we end the class. We have about 12 minutes, right? This company is expected to have dividends grow at a rate of 12% for the next 3 years. In 3 years, the dividends will settle down to a more sustainable growth rate of 6%, which is expected to last forever. If the company just paid a dividend of $2 and its level of risk is 10%, what is the intrinsic value? Okay, this is similar to the one that we see. So let's do this. Okay. Right. So we will have a line. Okay, start with 0, 1, 2, 3, 4. Okay. Right. So what is D0? $2, right? By now you should know. Okay. I just paid a dividend of $2. What is D1? $2 times. What is the growth rate for the first 3 years?
6%.
the growth rate for the first 3 years,
12.
12%. Okay, so you multiply by 1.2. Okay. So what do you get? 2 times 1.12.
8.95. Okay.
2 times 1.12.
2.24.
2.24. Okay. Then D2 simply 2.24 times 1.12 because it's still the same growth rate.
2.50. 2.51.
2.51. Then D3 okay, still 2.51 times 1.12, you will get 2.81. So I simplify here 2.81. Then D4. Okay, what is your D4? 2.81. Be careful, times 1.06. Because year 4 okay, will be the for the next 3 years. Okay, so after this should be after the 3 years, the dividend will settle down to a more sustainable growth rate of 6%. Okay, so this means that the 6% will start in year 4. Okay, that is what is implied here, right? Then, so to find D4 is 2.81, which is D3 times 1.06, okay, which is 2.98. 2.98. Okay, so now you have 5 figures here. Okay? D0, D1, D2, D3, and D4. Okay? And before that, in the earlier example of the final cash flow, we did not include D0. Okay? The reason is that this is not the expected cash flow. This is the historical cash flow. Okay, so that's why we did not include D0 into the final intrinsic value calculation. Okay. Okay, next, what is the next step? What should we do next? Come on. Since we know that D4 is the first dividend that will start growing at the constant growth rate forever, this tells us what? This tells us that we can calculate P3, correct? Okay, so in order to calculate P3, we need D4 divided by K minus G. How do we know this? We know this because we utilize the Gordon formula, which says that P0
0. D1.
D1 divided K minus G. You need to be able to see this. You need to be able to understand this to solve the question later on. If not, then it's difficult. Okay. So, of course, the basic Gordon is P naught equals to D1 divided by K minus G. Okay. But to apply this into this context, since year 4 would be the first year that the dividend will start to grow at the constant growth rate forever, starting here, then we can find P3. Okay. So utilizing this, we have our P3 would be T4 is 2.98 divided by your K is 10%, your G is 0.06. Okay, so it's basically 2.98 divided by 0.04 lah. Okay, so in this case, your P3 would be 2.98 divided by 0.04, 74.5. Okay, now what? Now it's the time for you to find your intrinsic value of the stock, P0 or P0, which is, do you include $2 here, D0? Do you include D0, $2?
Hmm.
Yeah, many students have done that. It's wrong. We don't include 20 because this is historical in the past. Remember, valuation is about the future, the expected cash flow, the future cash flow. So standing here at P0, this has passed. Okay? So the next one would be D1, is the first future cash flow that you will see. Okay, so it's 2.24. Okay, what is the discount rate? 1.1 to the power of -1. Why -1? Because this is
Year
end
one.
of year 1. Okay. Next is 2.51, 1.1 to the power of -2, then 2.81, 1.1 to the power of -3. Remember, you also need to discount P3, which is in the same year, okay, as D3. So in year 3, you have two cash flows, okay, the D3 and also P3. Okay. So your P3 would be 74.5. Okay. Stairs. Okay, you can solve this in one operation using the calculator. Okay, it's quite straightforward. So 2.24, okay, times 1.1 to the power of -1 plus 2.51 times 1.1 to the power of -2 plus 2.81 times 1.1 to the power of -3 plus 74.5 times 1.1 to the power of -3. So you get 62.19. You should get 62.19. Okay, when you calculate the present value of all these four cash flows, D1, D2, D3, and P3. Okay. So don't include D0 and don't include D4. Okay. The examples of mistakes that students normally make, they put in D0 and they put in D4 as well. D4 is not necessary since it is already included in P3. Okay. Right. Okay, any question? If you have. Okay, if not, we will continue on with the stock valuation next week. There's another portion of stock valuation that we are going to cover. Right. In the meantime, You have assignment 1 due on the 10th, right?
Yes.
Yes.
Submission
Okay.
on 10.
Right. So I'm going to give you another quiz. Okay, but only on bond. Okay, a simple quiz on bond, and I will make the due date after 10 lah, because maybe you need to prepare for the assignment before 10, possibly 11 or 12. 11 will be the next class already. Doesn't matter. Okay. So I put it in the online learning. I will inform you whenever I have uploaded it in the online learning. Right.
Okay, Doctor.
Okay.
Okay, Doctor. Okay.
Right. So just check the attendance. Hold on, yeah. For the KL, Khairul Zaim, not can yet. Never mind.
Yes, Doctor. Can you reshare again?
Never mind. I put it
Okay.
manual.
Thank
Okay,
you,
it's
Doctor.
for Sinto. Hold on. Sinto. Dong Xiao Xiao, not in the class, right? Are you in?
I'm here, Doctor.
Oh, but you did not
Yeah.
scan. Okay, I register you manually. Nazifah? Nazifah not in.
I'm here, Doctor. Can you add me manually?
Okay, I add manually. Huang.
Thank you, Doctor. Hi.
Okay, Chandra ada kan? Okay. Ashraf ada. Okay, I add manually. Okay, done. All right, thank you. See you all next week. And happy weekend lah. It's a long holiday.
Thank you,
Monday.
Doctor.
You, Doctor.